Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The information provided is not a substitute for professional advice from a qualified expert. Always consult with a licensed professional before making any financial decisions, and be sure to read the fine print of any insurance policy you consider. The average American driver overpays for auto insurance by more than $400 every single year. Let that sink in. $400. That's a new set of tires. It's a weekend getaway. It's a significant payment on your credit card, and it's vanishing from your bank account for absolutely no reason. But here's the secret the multi-billion-dollar insurance industry doesn't want you to know. 4 million of you. That $400 figure is a wild underestimate. The real number is often double or even triple that. How is this possible? They are counting on one simple, predictable human behavior: your inertia. Your reluctance to shop around. Your feeling that it's too complicated, too time-consuming, or just too much of a hassle. They have engineered a system that profits from your loyalty, and today we are going to break that system. This isn't just another video with the list of 10 cheap insurance companies. This is a masterclass. This is a playbook. By the end of this journey, you will not only know how to find the cheapest auto insurance rate available to you, but you will understand the why behind it. You will have a repeatable system you can use for the rest of your life to ensure you are never, ever taken advantage of again. We are going to demystify the jargon, expose the pricing tricks, and give you the exact strategies the pros use to slash their premiums, sometimes by 50% or more, without sacrificing a single drop of critical coverage. Have you ever opened that renewal notice in the mail, your heart sinking as you see the price has jumped 10, 20, even 30%? You haven't had an accident. You haven't gotten a ticket. You've done nothing wrong. So why are you being punished? It's a phenomenon the industry calls price optimization. But let's call it what it really is: a loyalty tax. They are betting that you'll sigh, complain to your spouse, and then just pay it because it's easier than fighting back. That ends today. The power is about to shift from their hands into yours. Over the next several parts, we're going to build your knowledge from the ground up. We'll dissect every type of coverage from liability to comprehensive, so you know exactly what you're buying and what you can safely decline. We will uncover the dozens of hidden discounts that most people don't even know exist, and I'll show you how to ask for them. We'll explore the psychology of getting a quote and how tiny changes in your answers can have a massive impact on your final price. We'll even talk about how your credit score, your zip code, and even your job title are being used to calculate your rate and what you can do about it. This is your complete guide to mastering the game of auto insurance. But first, we have to destroy the single most dangerous myth in this entire industry. The myth that the cheapest policy is the best policy. This is a lie. It's a trap that can lead to financial ruin. Chasing the absolute lowest number on the screen without understanding what it represents is like buying the cheapest parachute you can find. It might feel great when you hand over the money, but you're in for a world of pain when you actually need it to work. The goal is not to find the cheapest insurance. The goal is to find the best value, the most robust protection for your specific needs at the lowest possible price. A cheap policy with rock-bottom coverage limits might save you $20 a month, but a single not even your fault accident could leave you with a $100,000 lawsuit that your cheap policy won't cover. That's not a savings. That's a catastrophe waiting to happen. To avoid this trap and build a solid foundation, we're going to filter everything through what I call the 3 pillars of smart insurance. Every decision you make, every quote you get, every policy you consider must be evaluated against these 3 pillars: coverage, cost, and company. Pillar number 1 is coverage. This is your shield. This is the actual product you are buying. It's not just a piece of paper. It's a legal promise to protect your financial life. We're talking about things like liability, collision, and comprehensive. Think of it this way: liability coverage is for the other guy. If you cause an accident, this is what pays for their medical bills and their car repairs, so you don't have to sell your house to do it. Collision coverage is for your car when you mess up. It pays to fix or replace your vehicle if you hit another car or an object, regardless of who's at fault. And comprehensive coverage? That's for everything else. It's the acts of God and criminals policy. A tree falls on your car, a hailstorm turns your hood into a golf ball, a thief smashes your window, or you hit a deer on a dark road. That's what comprehensive is for. Understanding the fundamental difference between these is the first step to not getting ripped off. Pillar number 2 is cost. This is the price tag. This is what you pay for the protection offered by your coverage. But what actually goes into that number? It's a complex algorithm that looks at hundreds of data points about you. The obvious ones are your driving record, the type of car you drive, how many miles you drive each year, and where you live. But the hidden factors are just as important. Your credit score in most states has a massive impact on your premium. Your age, your gender, your marital status, it all goes into the machine. We are going to spend a huge amount of time in this series showing you which of these factors you can control and how to optimize them to dramatically lower your costs without touching your coverage. And that brings us to pillar number 3, company. This is your partner. This is the entity you are trusting to be there for you on what could be one of the worst days of your life. A policy is only as good as the company that writes it. Who are you giving your money to? Are they financially stable? Do they have a history of paying claims quickly and fairly? Or do they have a reputation for fighting their own customers tooth and nail? The cheapest premium in the world is worthless if the company disappears or buries you in paperwork when you file a claim. We'll show you how to vet an insurance company like a professional, checking their financial strength ratings and their customer complaint ratios, so you can partner with a company that will have your back when it matters most. Coverage, cost, and company. Your shield, your price tag, and your partner. Every single thing we discuss will come back to balancing these 3 pillars to find that sweet spot, that perfect intersection of robust protection, affordable price, and a trustworthy provider. This is the framework. This is the map that will guide us through the jungle of the insurance world. So, where do we begin our deep dive? We start with the single most important, most misunderstood, and most legally critical part of your entire policy: liability coverage. This is the one part of your insurance that, if you get it wrong, has the power to financially ruin you and your family for life. So let's talk about it. Liability coverage is the absolute bedrock of your auto insurance policy. And here's the first thing you need to understand, the part that confuses almost everyone. Liability coverage is not for you. It doesn't pay a single penny to fix your car. It doesn't pay a single one of your medical bills. It has zero benefit to you directly. Liability coverage is for the other person. It's the money your insurance company pays out when you are at fault for an accident that damages someone else's property or injures someone else. It's broken down into 2 simple parts: bodily injury liability and property damage liability. Think of it like this: bodily injury is for their hospital bills. Property damage is for their Honda. When you look at your policy, you'll see 3 numbers separated by slashes. It might look something like 25/50/25. This is the secret code of your financial safety net, or lack thereof. Each state requires you to have a certain minimum amount of this coverage to legally drive. This is called the state minimum. And this right here is the single most dangerous financial trap in the entire insurance industry. Because state minimum sounds official, doesn't it? It sounds like a government recommendation. It's not. The state minimum is not the recommended amount of coverage. It's the absolute, rock bottom, least you can possibly have and still be allowed to have a license plate. It's the D- of insurance coverage. You're technically passing, but you are one tiny mistake away from complete failure. And millions of Americans, trying to save money, check that state minimum box without a second thought. They save maybe $20, $30, $40 a month. And in doing so, they are playing a game of financial Russian roulette every single time they get behind the wheel. Let me tell you about a guy we'll call Mark. Mark is a good guy. He's 32, has a decent job in IT. He's saving up for a down payment on a house. He's a safe driver, never been in a serious accident. One day, he's looking at his bills and decides to shop for cheaper car insurance. He goes online, types in his info, and sees a bunch of quotes. One is significantly cheaper than the others. He looks at the details, and to get that low price, he just has to select his state's minimum liability coverage, 25/50/25. He thinks, $25,000? $50,000? That sounds like a lot of money. I'm a safe driver, what could possibly happen? So he clicks the button. He saves $35 a month. He feels smart. He feels responsible. 6 months later, Mark is driving home from work. It's raining lightly, the roads are slick. He's stopped at a red light behind a brand new Toyota Sienna minivan. The light turns green. Traffic starts to move. His phone buzzes with a notification. He glances down for just 1 second. But in that 1 second, the minivan in front of him suddenly stops. He doesn't have time to react. He slams into the back of it. It's not a high-speed crash. Just a classic, everyday fender bender. Everyone seems okay, just shaken up. They exchange information, the police come. A report is filed. Mark thinks, well, this is annoying, but that's what I have insurance for. This is where his life starts to unravel. First, the property damage. That new minivan is loaded with technology. It has parking sensors in the bumper, a rear-view camera, a hands-free liftgate. The initial estimate to repair the bumper, the sensors, and the gate assembly comes back. The total is $29,000. Mark's property damage limit, that last number in 25/50/25, is $25,000. His insurance company writes a check for $25,000 and says, "That's our limit. We're done." The other driver's insurance company then turns to Mark. He is now personally, legally on the hook for the remaining $4,000. His savings account takes an immediate $4,000 hit. Painful. But he thinks the worst is over. It's not. Not even close. A few weeks later, the letters start arriving. The minivan had a family in it. A mother, a father, and their teenage son. At the scene, they said they felt fine. But the next morning, the mother woke up with severe neck pain and a headache. Whiplash. The father's wrist, which he'd braced against the dashboard, was throbbing. Let's follow the money for just the mother. She goes to the emergency room. That's a $2,000 bill right there. They tell her to see a specialist. The specialist orders an MRI. That's another $3,000. The MRI reveals a herniated disc in her neck. The treatment plan? Months of physical therapy, chiropractic care, and pain management injections. She also has to miss 2 months of work from her job as a graphic designer because she can't sit at a desk without debilitating pain. Let's add it up. The ER visit, the specialist, the MRI, the months of physical therapy, the lost wages. Her total medical claim comes to $40,000. Now let's look at Mark's policy. 25/50/25. That first number, 25, is the bodily injury limit per person. It means his insurance will pay a maximum of $25,000 for any single person's injuries. The mother's bills are $40,000. So Mark's insurance pays out its max of $25,000. Who pays the other $15,000? Mark does. He is now personally liable for another $15,000. But we're not done. Remember the father? His wrist is diagnosed as a hairline fracture. He needs a cast, several follow-up visits with an orthopedic surgeon, and he misses 3 weeks of work at his construction job. His total claim for medical bills and lost wages comes to $18,000. Mark's policy has a $25,000 per person limit. So that should cover the father's $18,000 claim, right? Yes, but there's another number we have to look at. The middle number. The 50 and 25/50/25. That is the total bodily injury limit per accident. It means that no matter how many people are injured, Mark's insurance company will not pay more than $50,000 total. So let's do the final math. The insurance company paid $25,000 for the mother. They have $25,000 left before they hit their $50,000 total limit for the accident. They used that remaining money to pay $18,000 for the father's claim. Great. But remember, the mother still had an outstanding balance of $15,000 that the insurance didn't cover. So, the grand total that Mark is now personally responsible for? $4,000 for the van, $15,000 for the mother's remaining medical bills. That's $19,000. $19,000 out of his own pocket. His down payment fund for a house? Gone. His emergency savings? Gone. He'll have to drain his 401k or take out a personal loan. And for what? To save $35 a month. That's $420 a year. He wiped out decades of future savings to save $420. And Mark's story is a good outcome. What if that minivan had swerved into oncoming traffic? What if someone had been permanently disabled? What if the claim wasn't $50,000 or $60,000 but $500,000? Or $1 million? A jury doesn't care what your insurance limits are. They care what the victim's medical bills are. If a court awards a victim $500,000 and you only have $50,000 in coverage, you are on the hook for the other $450,000. They will garnish your wages for the rest of your working life. They will put a lien on your home. They will seize your assets. Everything you have worked for, and everything you ever will work for, can be taken away because you tried to save a few bucks on your car insurance. This is not a scare tactic. This happens every single day in every single state. So what is the right amount of coverage? The answer is simple. As much as you can possibly afford. For most people in the United States, the bare minimum you should even consider is 100/300/100. That's 100,000 per person, 300,000 per accident, and 100,000 for property damage. In today's world of $60,000 pickup trucks and million-dollar medical bills, even that might not be enough. But it is a sane, responsible starting point that protects you from the average accident turning into a life-destroying financial catastrophe. Now you're probably thinking, that sounds expensive. Going from 25/50/25 to 100/300/100 must cost a fortune. And this is the most incredible, most surprising, and most important secret I can share with you. It is shockingly cheap. The difference in price to quadruple your protection is often marginal. Sometimes it's as little as the cost of one coffee a week. Increasing your liability coverage is the single highest value, lowest cost decision you can make. And in the next part, I'm going to show you exactly how to price this out for yourself in real time. And we're going to tackle the second biggest mistake people make, the one that keeps even well-insured people from ever using their policy: completely misunderstanding how your deductibles actually work. Let's imagine two neighbors, Sarah and Mike. They have identical cars, identical driving records, and live on the same street. They both go online to get an auto insurance quote. Mike sees a premium for $60 a month and instantly buys it. He's thrilled. He's beating the system. Sarah gets a quote for $85 a month for what looks like the exact same coverage, and she buys that one. Mike laughs. He tells Sarah she's getting ripped off, paying an extra $300 a year for nothing. Fast forward 6 months. A nasty hailstorm rolls through their town. Both of their cars are parked outside and get hammered. They look like golf balls. It's a mess. They both call their insurance companies to file a comprehensive claim. The body shop quotes them both the same price, $2,000 for the repair. This is where the story changes. Sarah's insurance company tells her, "Okay, Sarah, your comprehensive deductible is $500. You pay the first $500 to the body shop, and we will immediately send them a check for the remaining $1,500. Your car will be good as new." Sarah is annoyed about the hail, but relieved. She has $500 in her emergency fund, so she pays it, and her car is fixed. Then it's Mike's turn. He calls his insurance company, feeling smug about his $60 a month premium. The adjuster tells him, "Okay, Mike, the repair is $2,000. Your comprehensive deductible is $2,000. Mike is confused. He says, "Wait, what? What do you mean?" The adjuster replies, "Well, sir, to get that $60 monthly rate, you chose the highest possible deductible. You have to pay the first $2,000 of any claim. Since the repair cost is exactly $2,000, you're responsible for the full amount. There's nothing for us to pay." Mike is floored. His jaw hits the ground. He has to come up with $2,000 on his own, or drive around in a dented-up car. That cheap $60 a month policy just cost him $2,000. He saved $150 in premiums over those 6 months, but he's now facing a bill more than 10 times that amount. Suddenly, Sarah's $85 a month policy looks like the deal of a lifetime. This right here is the deductible trap, and millions of people fall for it every single year. A deductible is the simplest concept in insurance, and yet it's the most dangerously misunderstood. Put simply, your deductible is the amount of money you have to pay out of your own pocket for a repair before your insurance company pays a single penny. It's your share of the risk. When you file a claim for damage to your car, you pay the deductible first. Think of it like a cover charge to get into the insurance pays for everything club. Now, you don't have just one deductible. Typically, you have 2 main ones that you need to worry about. The first is your collision deductible. This applies when your car is damaged in a collision with another object, another car, a pole, a guardrail, you name it. If you cause an accident and your car is damaged, you'll pay your collision deductible to get it fixed. The second is your comprehensive deductible. This is for almost everything else. Think of it as the acts of God and bad luck coverage. Hail damage, a tree branch falling on your roof, theft, vandalism, hitting a deer. All of these typically fall under your comprehensive coverage. And for each one, you'll have a separate deductible. Here's the key. You can set these 2 deductibles at different amounts. Common deductible amounts are $250, $500, $1,000, or even $2,000 like our friend Mike. And this brings us to the most important financial decision you will make when buying your policy. There is an unbreakable rule in insurance. The higher your deductible, the lower your monthly premium. The lower your deductible, the higher your monthly premium. Insurance companies are rewarding you for taking on more risk yourself. If you're willing to pay the first $1,000 of a claim, they see you as less of a risk than someone who only wants to pay the first $250. So they give you a discount on your premium. This is where people get into trouble. They go online, they see that slider for the deductible, and they slide it all the way to the right to get the absolute lowest monthly payment. They see the premium drop by $20 or $30 a month and think, I'm a genius. They never stop to ask the single most important question. If I got into an accident tomorrow, could I comfortably right now write a check for that deductible amount without it causing a major financial crisis in my life? If the answer to that question is no, then your deductible is too high. Period. It doesn't matter if it saves you $20 a month. A policy you can't afford to use is worthless. It's not insurance. It's just a piece of paper you're legally required to have that gives you a false sense of security. So, how do you find the sweet spot? You need to do two things. First, be brutally honest with yourself about your finances. How much cash do you have readily available in an emergency fund? Not money you need for rent, not money you'd have to pull from a 401k, but actual liquid cash you could access tomorrow. If you have $1,000 saved up for emergencies, then a $500 deductible is probably a great fit. A $1,000 deductible might be pushing it, but it's manageable. A $2,000 deductible would be a catastrophic mistake. Your emergency fund is your safety net, and your deductible should never be larger than that net. Second, you need to run the numbers. Let's say you're deciding between a $500 deductible and a $1,000 deductible. Go to a quoting site and get a price for both. Let's say the policy with the $500 deductible is $100 a month, and the policy with the $1,000 deductible is $85 a month. You'd save $15 a month by choosing the higher deductible. That's $180 a year. Now ask yourself, is saving $180 a year worth taking on an extra $500 of risk? To figure that out, you have to calculate your break-even point. In this scenario, it would take you almost 3 years of being accident-free just to save enough in premiums to cover the difference in the deductible. If you have one single at-fault accident in that 3-year period, you've lost money. You would have been better off paying the higher premium for the lower deductible. For most people, especially those who don't have a massive emergency fund, a deductible of around $500 for both collision and comprehensive offers the best balance of affordable premiums and manageable risk. It's a number that most people can handle in an emergency, so they can actually use the insurance they're paying for. And here's a pro tip. Consider setting your comprehensive deductible lower than your collision deductible. Why? Because comprehensive claims, like a cracked windshield or hitting a deer, are often not considered at-fault accidents and may not raise your rates. They're also often less expensive to fix. It might only cost a few extra dollars a month to have a $250 or even a $100 comprehensive deductible, which can be a lifesaver when you get an unexpected rock chip that spiders across your entire windshield. Finally, when you're shopping, ask about something called a diminishing or disappearing deductible. Some top-tier companies offer this as a perk. For every year you go without an accident, they will reduce your collision deductible by a certain amount, say $100, at no extra cost to you. So after 5 years of safe driving, your $500 deductible could literally become zero. This is an incredible feature that rewards you for being a good driver and can save you a fortune when you finally do have a claim. So the second biggest mistake is choosing a deductible based on the monthly premium instead of your actual financial reality. It's the illusion of savings. You feel like you're winning every month right up until the moment you lose, and you lose big. A low premium is great, but a policy you can actually use when you need it most is priceless. So go look at your policy right now. Find your collision and comprehensive deductibles. Ask yourself that one honest question. If I got in a wreck on the way home today, could I write a check for that amount without breaking a sweat? If the answer is no, you need to log into your account or call your agent and adjust it today. But even if you get your deductible perfect, you could still face financial ruin from one single accident. Because we haven't talked about the numbers that really matter. The ones that protect you from losing your house, your savings, and everything you've ever worked for. We're talking about liability limits, and in the next part, I'm going to show you why the state minimums are a legal trap designed to bankrupt you. Think about it. The government sets a speed limit. If you go 1 mile per hour over, you're breaking the law. But when it comes to the insurance that protects your entire financial life, They set the bar so low it's practically buried in the dirt. They tell you, get this much coverage and you're legal. But what they don't tell you is that being legal and being safe are two terrifyingly different things. The state minimum isn't a safety net. It's a tripwire. It gives you just enough rope to hang yourself financially, and millions of Americans are walking around with this noose around their necks, thinking it's a necklace. Let me tell you a story about a guy we'll call Mark. Mark is a good guy. He's 32, works in IT, and has been diligently saving for a down payment on his first home. He's got about $20,000 in the bank, the product of years of skipping vacations and packing his lunch. He's responsible. So when it came time to renew his car insurance, he did what any smart budget-conscious person would do. He shopped around for the cheapest rate that was still legal. He saw his state's minimum requirement, 25/50/25. That's $25,000 for bodily injury per person, $50,000 total per accident, and $25,000 for property damage. He thought, perfect. The government says this is enough, so it must be enough. He saved himself about $40 a month, a little under $500 a year. That's a win, right? One Tuesday afternoon, Mark is driving home from work. He's stopped in traffic. His phone buzzes on the passenger seat. A text from his realtor. He glances down for just 1 second. 1 second. But in that 1 second, the car in front of him, which he thought was stopped, had started to inch forward and then stopped again. By the time Mark looks up, it's too late. He slams on the brakes, but it's a gentle roll, a 5-mile-per-hour impact. Crunch. Doesn't even seem that bad. No airbags deployed. He gets out, his heart pounding. He's hit a brand new Toyota Highlander. A mom, a dad, and their 10-year-old son are inside. Everyone says they're okay, just a little shaken up. They exchange insurance information. Mark apologizes profusely. He calls his insurance company, reports the minor accident, and thinks the worst is over. He couldn't have been more wrong. This was the moment his life changed forever. A week later, the first call comes. It's the body shop. The Highlander Mark hit looks like it just has a damaged bumper. But behind that plastic bumper cover are proximity sensors, a backup camera, and impact-absorbing structures. The tailgate is bent and won't close properly. The estimate to repair the Toyota Highlander is $28,000. Mark had $25,000 in property damage coverage. His insurance company sent a check for $25,000 to the other driver's insurance, and then Mark got a certified letter in the mail. It was a bill for the remaining $3,000. Plus, the family needed a rental SUV for the 3 weeks their car was in the shop, which cost another $2,000. Suddenly Mark, the guy who was saving every penny, had to write a check for $5,000, wiping out a quarter of his down payment savings. He was furious, stressed, but he thought, okay, I can recover from this. At least no one was hurt. But they were hurt. You see, the adrenaline from a car crash can mask injuries. A few days later, the driver of the Highlander, the dad, woke up with excruciating neck pain and numbness in his arm. He went to the doctor. Diagnosis: a herniated disc from the whiplash. The mom had severe back strain. Their son was fine, thank God. The dad's initial ER visit, MRI, and consultation with a specialist came to $15,000. The mom's physical therapy bills added up to another $10,000. The total medical bills were $25,000. Mark had the 25/50 bodily injury coverage, $25,000 per person, $50,000 per accident. So, his insurance paid the mom's $10,000 bill in full, and it paid the full $25,000 limit for the dad's injuries. Mark's insurance company had now paid a total of $50,000, $10,000 for the mom, $25,000 for the dad, and that $25,000 for the car, and they were done. They had met their legal obligation. They washed their hands of Mark. But the dad's medical bills weren't stopping. His herniated disc required months of painful physical therapy, injections, and he might eventually need surgery. On top of that, he was a self-employed electrician, and the injury meant he couldn't work for 3 months. That was $30,000 in lost income. So his total damages were the initial $15,000 in medical bills, plus $30,000 in lost wages, and his future medical costs were still unknown. His claim was already worth more than $45,000, but Mark's insurance had only paid $25,000. That's when the second letter arrived. This one wasn't from an insurance company. It was from a law firm, a very aggressive, very expensive law firm. The letter politely informed Mark that since his insurance policy limit had been reached, He was now personally responsible for the remaining $20,000 in medical bills and lost wages. And then came the sentence that made his blood run cold. They were also suing him for $200,000 for pain and suffering. In an instant, Mark was on the hook for $220,000. His $20,000 life savings? Gone. The dream of a house? Vanished. The law firm put a lien on his assets. They started the process to garnish his wages. For the next 15 to 20 years, a portion of every single paycheck Mark earned would be taken from him to pay for that 1-second glance at his phone. He had to hire his own lawyer, costing him thousands more, just to manage the bankruptcy. All because he wanted to save $40 a month. He followed the law. He did what the state told him was adequate. And in return, the system he trusted led him straight into a trap that destroyed his financial life. This isn't a scare tactic. This is the reality of the numbers. Look at the car you're driving. Look at the cars around you on the road. A new Ford F-150 starts at $35,000. A Tesla Model Y, one of the most common cars on the road, can easily have a $20,000 repair bill from a minor fender bender because of its complex sensors and battery structure. Your $25,000 state minimum property damage limit is a joke. It might not even be enough to replace a totaled Honda Civic anymore. And the medical costs? It's even worse. A single ambulance ride can be $2,000. One night in a hospital can be $10,000. A complex surgery can be $100,000. That $2550 limit that sounds so official? It's not enough to cover one serious injury in one moderate accident. It's a financial death sentence. The state minimum isn't designed to protect you. It's designed to provide a tiny, minuscule amount of protection for the person you hit. After that tiny limit is gone, you are on your own. You, your savings, your paycheck, your future home. It all becomes fair game for the other person's lawyers. You become the insurance policy. So that cheap state minimum policy isn't a bargain. It's a bet. You are betting your entire financial future. Everything you have and everything you will ever earn. That you will never, ever make a mistake. That you will never glance away for 1 second. That the person you hit is driving a 20-year-old beater and has superhuman healing abilities. It's the single worst bet a person can make. So how do you avoid this? How do you build a real financial fortress around yourself? What are the right numbers? The ones that let you sleep at night? You have to move past what's legal and start thinking about what's smart. It's not about just picking random high numbers. It's about matching your coverage to your life. The right amount of insurance for a 22-year-old renting an apartment is different from a 45-year-old who owns a home and has a retirement account. So what are the right numbers for you? How much liability coverage do you actually need to protect your assets in your future? Is it 100/300/100? Is it 250/500/250? The answer depends on one simple question about your life. And in the next part, I'm going to give you the exact formula to figure out your financial fortress number, ensuring you are never ever in Mark's position. That one simple question is this: what are you worth? I'm not talking about your value as a person. I'm talking about your net worth, your financial footprint. Because when you get into a serious accident, and the lawyers for the other side start circling, that is the first and only question they are going to ask. They aren't trying to figure out how to make the injured person whole. They are trying to figure out how much they can take from you. Your car insurance isn't just about fixing the other person's car or paying their medical bills. It's a shield. It's a financial fortress designed to protect everything you have ever worked for and everything you ever will work for. Mark, the guy from our last part, had a shield made of tissue paper. He had state minimums. The moment the lawsuit exceeded his $50,000 limit, that shield dissolved, and the lawyers had a direct line to his savings account, his retirement, and even the equity in his house. They came for everything. Your job right now is to calculate the exact size of the shield you need. We're going to build your financial fortress, and we're going to do it with a simple 2-step formula. Grab a piece of paper or open the Notes app on your phone. This will take you 5 minutes, and it might be the most important 5 minutes you spend this year. First, we calculate your current net worth. This sounds complicated, but it's just addition and subtraction. On one side, you're going to list your assets. This is all the stuff you own. Start with the big ones. Your house. Don't just guess. Pull up Zillow or Redfin and get a realistic estimate of its current market value. Let's say it's $400,000. Next, your cars. Kelley Blue Book. What's the private party value of your vehicles? Let's say you have 2 cars worth a combined $30,000. Now your cash. Open your banking app. How much is in your checking and savings accounts combined? Let's say it's $20,000. Now your investments. This is your 401k, your IRA, any brokerage accounts you have. Log in and get the exact number. For our example, let's say it's $150,000. Finally, think about any other significant valuables. A boat? Expensive jewelry? Art? For most people this category is small, so we'll call it 0 for now. Add it all up. In our example, $400,000 for the house, $30,000 for the cars, $20,000 in cash, and $150,000 in investments. That's a total asset value of $600,000. Now for the easy part, subtraction. We need to list your liabilities. This is all the money you owe. Start with the biggest, your mortgage. What's the remaining balance? Let's say it's $250,000. Next, your car loans. What's the total payoff amount for both cars? Let's say it's $15,000. Now student loans. Painful one for many, but you have to include it. Let's say you have $40,000 left. And finally, credit card debt. Add up the balances on all your cards. Let's say it's $10,000. So your total liabilities are $250,000 plus 15 plus 40 plus 10. That's $315,000 in debt. Now for the magic. Assets minus liabilities equals net worth. $600,000 in assets minus $315,000 in liabilities equals a net worth of $285,000. This number, $285,000, is the absolute bare minimum your liability insurance needs to cover. This is the value of your fortress. If you have 100/300/100 coverage, that middle number, 300,000, is your shield. In this case, it's just big enough to cover your current net worth. It protects your house, your savings, your retirement. You've successfully built a wall around your past work. But we're not done. Because a savvy lawyer won't just look at what you have now. They'll look at what you're going to have in the future. This is the part that trips almost everyone up. And it's what can lead to financial ruin, even for people who think they're protected. I'm talking about your future earnings. If you are a high-income earner, a doctor, a lawyer, a software engineer, a successful business owner, you are a massive target. Let's say you're a 30-year-old resident physician. Your net worth might actually be negative because of student loans. You might think, I have nothing to protect. You are dangerously wrong. A court can, and absolutely will, award a judgment that includes garnishing your future wages. They can put a lien on your income for decades. They can legally claim a piece of every single paycheck you earn for the rest of your career. So, the second part of our formula is to account for this future risk. You don't need to be a financial analyst to do this. Just think about it logically. How many working years do you have left? What's your realistic income potential? If you're a 40-year-old earning $100,000 a year with 25 years left to work, your future earning potential is $2.5 million. Court sees that. A lawyer salivates over that. You don't need to insure the full $2.5 million, but you need to acknowledge that you're a bigger target than someone earning $30,000 a year. So for your financial fortress number, you take your net worth and you add a future risk factor. If you're a high-income earner or have a high-growth career, you need to add at least another $200,000 to your net worth calculation. If you're in a more stable, lower-income job, maybe you add $50,000. So let's go back to our example. A net worth of $285,000. Let's say this person is a school teacher with a solid, but not astronomical, income. We'll add a $75,000 future risk factor. Their financial fortress number is now $360,000. Now we can finally answer the question from the last part. How much liability coverage do you need? You need to match it to your fortress number. In this case, $360,000. You look at the standard insurance options. 100/300/100 gives you a $300,000 shield. It's not enough. It leaves a $60,000 hole in your fortress wall. The next standard level up is typically 250/500/250. That gives you a $500,000 shield. That is the correct choice. It completely covers your fortress and gives you a comfortable buffer. You are protected. You can sleep at night. This is the formula. Net worth plus future risk factor. Calculate that number, and then pick the liability coverage level that meets or, ideally, exceeds it. Stop gambling with state minimums. Stop guessing with 100/300/100. Do the math. It's the only way to be sure. But what if you do the math and your number is bigger? What if you're a business owner with a net worth of $800,000? Or a surgeon with a net worth of $1.5 million? You'll quickly find that auto insurance policies top out. You can't just call Geico and ask for $1 million liability policy. It doesn't exist. So how do these people protect themselves? How do you build a fortress that big? They use a little-known tool, a secret weapon that costs surprisingly little, but provides a massive $1 million layer of extra protection. It sits on top of your auto and home insurance, and it's the single biggest difference between amateur and professional financial planning. And in the next part, I'm going to show you exactly what it is, how it works, and how you can get it for less than the cost of a daily coffee. This secret weapon is called a personal liability umbrella policy, and it's not just a clever name. It acts as a literal umbrella over your existing auto and home insurance, shielding you from a catastrophic financial storm that your standard policies could never withstand. Let me paint a picture for you. Imagine a woman named Karen. She's a good person, a responsible driver. She has what most people would consider good car insurance. She pays her premiums on time and even opted for higher liability limits than the state requires. $300,000. She feels protected. One rainy Tuesday morning, she's driving to work on the interstate. Traffic is heavy. She glances down for a split second to check her GPS. And in that moment, the car in front of her slams on its brakes. Karen reacts, but the wet road makes her car hydroplane. She skids, not just hitting the car in front of her, but spinning out and causing a chain reaction involving 3 other vehicles. It's a bad accident. One driver, a surgeon, suffers a severe hand injury that will require multiple surgeries and may prevent him from ever operating again. Another car had a family of 4, and 2 of them have serious neck and back injuries requiring long-term physical therapy. The initial shock of the accident quickly wears off and is replaced by the cold, hard reality of the financial fallout. The surgeon's lawyer calls. His lost income alone is projected to be in the millions over his career, and they are suing Karen for $2 million. The family in the other car sues for $800,000 to cover their medical bills, pain and suffering, and ongoing care. That's a total of $2.8 million in lawsuits. Karen's good car insurance, with its $300,000 liability limit, is gone in an instant. It's like trying to put out a forest fire with a water pistol. The insurance company writes the check for $300,000, and then their obligation is done. They wish her the best of luck. But Karen is still on the hook for the remaining $2.5 million. What happens next is the nightmare that most people think only happens in movies. The court enters a judgment against her. To satisfy that judgment, they go after everything she has. They seize her savings account. They force the sale of her home, taking all the equity she spent 15 years building. They take her retirement accounts, the money she was carefully saving for her future. And even after all of that, she still owes over $1 million. So the court orders her wages to be garnished. For the next 20 years, a significant portion of every single paycheck she earns goes directly to the people she injured. That one split-second mistake on a rainy Tuesday didn't just cause an accident. It completely erased her financial past, present, and future. This story isn't an exaggeration. It happens every single day in America. A momentary lapse in judgment, a patch of black ice, a deer jumping into the road. Any of it can lead to a lawsuit that blows past your standard insurance limits and leaves you financially ruined for life. This is where the umbrella policy comes in. An umbrella policy is pure extra liability coverage. It does one thing, and it does it incredibly well. It protects your assets and future earnings when the liability on your home or auto insurance isn't enough. When Karen's $300,000 auto policy was exhausted, a $1 million umbrella policy would have kicked in, giving her another $1 million of coverage. A $2 million umbrella would have covered almost the entire judgment. Instead of losing her home and having her wages garnished for decades, she would have been able to walk away from the financial catastrophe, shaken but financially whole. So how does it work exactly? Think of it as a second-story insurance plan. To get one, insurance companies require you to have a solid foundation first. They'll typically require you to have a certain amount of liability coverage on your auto and home insurance policies already. For example, $250,000 per person, $500,000 per accident and bodily injury on your auto, and $300,000 in liability on your homeowners. These are your underlying limits. Once you have that foundation, the umbrella policy sits on top of both of them. This is a key point people miss. It doesn't just cover you for car accidents. If a delivery person slips and falls on your icy driveway and sues you for $500,000, and your home insurance only covers $300,000, your umbrella policy kicks in to cover the extra $200,000. If your teenager is accused of slander on social media and you get hit with a massive lawsuit, the umbrella policy can cover that too. It covers a huge range of personal liability risks, at home and on the road. Now you might be thinking, this sounds expensive. This sounds like something only wealthy people with mansions and yachts need. This is the single biggest, most dangerous misconception about umbrella insurance. The exact opposite is true. While the wealthy certainly have them, umbrella policies are arguably most critical for middle-class and upper-middle-class families. Think about it. If you're a billionaire, and you get hit with a $3 million lawsuit, you can write a check. It's painful, but it doesn't change your life. But if you have a net worth of, say, $500,000, made up of your home equity, your 401k, and your savings, that same $3 million lawsuit doesn't just hurt you. It wipes you out completely. Takes everything you've ever worked for. You, the person with a comfortable life but not unlimited resources, are the one who is most vulnerable. You have enough to lose, but not enough to absorb a major lawsuit. An umbrella policy is the financial firewall that protects your life's work from being incinerated by a single catastrophic event. So what about the cost? This is the most incredible part, and it brings us back to the promise I made at the end of the last section. For $1 million in extra coverage, a standard umbrella policy typically costs between $150 and $300 per year. Let's break that down. At the high end, $300 a year is $25 a month. That's about 83 cents a day. For less than the price of a cheap cup of gas station coffee, you can add $1 million layer of protection over your entire financial life. For the price of a daily Starbucks latte, you could probably get a $5 million policy. There is no other financial product in the world that gives you that much protection for that little money. It is, without a doubt, the single best bargain in the entire insurance industry. It's the difference between having a financial plan that can withstand a major shock and one that shatters at the first sign of trouble. Protects your house. It protects your retirement. It protects your kids' college funds. It even protects your future paychecks from being garnished. It's not just more insurance. It's a defensive shield for your entire net worth. And getting one is shockingly simple. You typically buy it from the same company that provides your auto and home insurance, which, by the way, usually results in even bigger bundling discounts on all three policies. So when we talk about finding the best cheap auto insurance, we have to expand our thinking. The cheapest policy isn't the one with the lowest premium. The best policy is the one that adequately protects you from ruin without costing a fortune. And the combination of a solid auto policy, a solid home policy, and a high-limit umbrella policy is the undisputed champion of providing maximum protection for minimum cost. It is the professional-grade strategy that separates savvy consumers from the amateurs who are unknowingly driving around, one text message or one slippery road away from total financial devastation. But just having the right policies isn't enough. The devil, as they say, is in the details. The fine print and the exclusions that can turn your ironclad protection into Swiss cheese right when you need it most. And there are a few critical traps buried deep within policy language that you absolutely have to know about before you ever sign on the dotted line. The first trap is one that millions of Americans fall into every single day, and it's called the business use exclusion. It sounds boring, but this little clause is a financial atom bomb waiting to go off. Imagine you're trying to make a little extra cash. You sign up for DoorDash or Uber Eats, or maybe you're an artist who delivers your own work from an Etsy shop. One afternoon, while on your way to drop off a pizza or a package, you get into a fender bender. It's not even your fault. You call your insurance company, confident you're covered, and then they ask the question, what was the purpose of your trip? The moment you say, I was making a delivery, the agent on the other end of the line goes quiet. And then they deliver the devastating news. Your claim is denied. Why? Because your standard, personal auto policy almost certainly has a clause that explicitly states it does not cover you while you are using your vehicle for commercial purposes, for business. This includes ride-sharing, delivery services, or any activity where you're being paid to transport goods or people. To them, it doesn't matter if it's your full-time job or a one-hour side hustle. They see it as a higher risk they didn't agree to cover. Suddenly, you're on the hook for not only your own car's repairs, but potentially the other driver's repairs and medical bills, which could run into the tens or even hundreds of thousands of dollars. The solution? You need a specific rideshare endorsement or a full commercial auto policy. It costs a little more, But that small price is the difference between a minor inconvenience and total financial ruin. Next up is a landmine that rips families and friendships apart: the permissive use versus the unlisted regular driver trap. Most policies have a permissive use clause. It means if you let your friend, let's call him Dave, borrow your car once to pick up a new TV, and he gets into an accident, you're likely covered. You gave him permission, it was a one-time thing. But here's where it gets dangerous. What if your roommate borrows your car 3 times a week to get to their job? What if your girlfriend, who lives with you but isn't on your policy, uses your car every weekend to run errands? In the insurance company's eyes, they are no longer an occasional permissive user. They have become a regular unlisted driver. And if they get into an accident, the insurance company has every right to deny the claim. Their argument is simple. A regular driver who lives in your household or uses your car consistently represents a daily risk. That risk needs to be accounted for in your premium. By not adding them to your policy, you were, in their view, hiding that risk from them. The line between occasional and regular is blurry, and insurers will use that ambiguity to their advantage. The heartbreaking reality is that people try to save a few bucks by not adding their 20-year-old son or their live-in partner to the policy, thinking they'll be fine. But one accident can unravel that entire gamble, leaving you with a denied claim and a massive bill. The rule is simple. If someone drives your car on a regular basis for any reason, they absolutely must be listed on your policy. Now, for all the car enthusiasts out there, this next one is critical. It's the custom parts and modifications exclusion. You've spent thousands of dollars making your car your own. You've added a new set of 20-inch rims, a thumping sound system, a custom exhaust, maybe even a turbocharger. Your car is your pride and joy. Then the worst happens. Your car is stolen, or you're in a major accident, and it's declared a total loss. You file your claim, expecting the insurance company to pay you the value of your amazing, customized machine. Instead, you get a check that's thousands, maybe even $10,000 less than you expected. You call them, furious, and they calmly explain that your policy only covers the stock or factory version of your vehicle. That $10,000 you invested? As far as they're concerned, it doesn't exist. Those expensive wheels are valued as basic steel rims. That custom leather interior is valued as standard cloth. All that time, money, and passion gone. This is because standard policies are designed to return a car to its factory condition, not its custom-built glory. To protect your investment, you need to add what's called custom parts and equipment coverage, or a CPE endorsement. It's a specific add-on that covers the value of your aftermarket parts. You'll need to provide receipts and photos, but for a relatively small increase in your premium, you can insure thousands of dollars in modifications, ensuring that if the worst happens, you get a check for what your car was actually worth. The fourth trap is the one people think they'd never fall into: the intentional acts and racing exclusion. Now, the intentional acts part seems obvious. If you have a road rage incident and purposely ram your car into someone else's, your insurance isn't going to cover you. That's a criminal act, not an accident. But the racing part is far broader than you might think. It doesn't just mean illegal street racing. This exclusion can apply to any timed event, speed contest, or high-performance driving activity that isn't specifically sanctioned and covered by a special policy. This includes taking your car to a local racetrack for an amateur track day. You might think it's a safe, controlled environment, but if you lose control and hit a wall, your standard auto insurance will wash their hands of it. The claim will be denied instantly. It also applies to things like autocross events in a parking lot or even informal, non-sanctioned off-roading events. If the insurer can argue you were using your vehicle in a competitive or extreme manner beyond its intended daily use, they can trigger this exclusion. So before you take your Subaru to that SCCA event or your Jeep to that off-road park, you need to read your policy carefully and look into specialty track day insurance. It might cost a few $100s for the day, but it's better than being on the hook for a $30,000 car. Finally, there's the silent policy killer: the geographic limitation and garaging misrepresentation trap. Many people don't realize that their standard U.S. auto policy may not fully cover them if they drive into Mexico, and sometimes coverage can even be limited in Canada. Driving across the border without securing a specific, separate insurance binder for that country could mean that the second your wheels touch foreign soil, you're completely uninsured. But the more common and deceitful version of this trap is garaging misrepresentation. This is a fancy term for lying about where you park your car most nights. Insurance rates are heavily based on your zip code. A car parked in a quiet, Rural town has a much lower risk of theft, vandalism, and accidents than a car parked on the street in a dense city like Los Angeles or Chicago. So what do people do? They register their car at their parents' house in the suburbs to get a cheaper rate, even though they and the car actually live downtown. This is fraud, and insurance companies have entire departments dedicated to sniffing this out. If your car gets stolen or hit while parked outside your real city apartment, and the investigation reveals you've been lying about your garaging address, they will not hesitate to deny your claim and cancel your policy. They may even come after you for the difference in premiums you should have been paying all along. The few $100s you thought you were saving just cost you your entire car and branded you as a fraud, making it incredibly difficult and expensive to get insurance in the future. The bottom line with all of these traps is that the fine print is not just a suggestion, it's a binding contract. And what you don't know can and absolutely will hurt you. So now you know the traps hidden in the policy language. But what happens when you actually have to use it? When you're standing on the side of a highway, heart pounding after a crash. The first few minutes, the first phone calls you make, can be the difference between a smooth claims process and a check for thousands, or a months-long nightmare that ends with a denial letter. And that's exactly what we're going to break down next. The step-by-step playbook for handling an accident and a claim like a seasoned pro. The good news is, this playbook isn't complicated. It's about staying calm, being methodical, and understanding the game you're suddenly forced to play. The moment you hear that sickening crunch of metal, a clock starts ticking. What you do in the next 60 minutes can be the difference between a closed case and a complete catastrophe. First things first, breathe. Your adrenaline is pumping. Your brain is in fight or flight mode. Take one deep breath. Now assess. Is anyone hurt? Yourself? Your passengers? The people in the other car? If there is any doubt whatsoever, any pain, any dizziness, your first and only job is to call 911. Don't be a hero. Don't try to tough it out. A minor ache now can become a major injury later, and having paramedics evaluate you at the scene creates an official record that is pure gold for your claim. If everyone seems okay and the cars are drivable, the absolute priority is to move to a safe location. Get out of the flow of traffic. Move to the shoulder, a side street, or a nearby parking lot. Leaving your cars in the middle of the road is the #1 cause of secondary accidents, which are often far worse than the first one. Turn on your hazard lights. Now, your smartphone becomes the single most important tool you own. Before you even speak to the other driver, you become a crime scene investigator. Take pictures of everything. And I mean everything. Start wide, showing the entire scene, the position of the cars, the traffic signals, the weather conditions, the time of day. Then get closer. Photograph the damage to both cars from multiple angles. Get low, get high. Take a picture of the other car's license plate. This is non-negotiable. People can give you fake names or expired insurance cards, but a license plate is a direct link to the vehicle's owner. Take photos of any skid marks on the road, any debris, any street signs or landmarks that establish the location. You cannot take too many photos. Your future self will thank you. Only after you have secured the scene and documented it do you exchange information with the other driver. Be calm, be polite, but be careful. Do not, under any circumstances, apologize or admit fault. Don't say "I'm so sorry" or "I didn't see you." In our culture, saying sorry is a reflex. Suppress it. In the world of insurance, an apology is an admission of guilt. It can and will be used against you by the other driver's insurance company. You need to get 4 key pieces of information: their full name, their phone number, their insurance company name, and their policy number. Take a picture of their insurance card and their driver's license. If they refuse or say they don't have it, that's a massive red flag. Insist on waiting for the police. In fact, even for a minor fender bender, I always recommend calling the police to file a report. Why? Because a police report is an objective, third-party account of the incident. The adjuster from Geico who lives 1,000 miles away wasn't there. They will treat that police report as the closest thing to gospel. Without it, the claim can devolve into a he said, she said nightmare, where the insurance company will almost always side with their own customer, not you. Once you're home and the adrenaline has worn off, it's time to make the call. This is another critical fork in the road. Do you call your insurance company or the other drivers? The answer is almost always, call your own company first. Even if the other driver was 100% at fault, reporting the claim to your own insurer initiates the process with the company you have a contract with. They have a legal obligation to you. You are their customer. They can guide you, start the repair process using your own collision coverage if you have it, and then they will fight on your behalf to get the money back from the at-fault driver's company through a process called subrogation. When you call, have your policy number and the police report number ready. State the facts clearly and concisely. I was involved in an incident on this date at this time at this location. Don't speculate on the cause. Don't guess at the speed you were going. If you don't know, say I don't know or I am not sure. The person on the other end of the line is taking detailed notes that will become a permanent part of your claim file. Stick to what you know for a fact. You will then be assigned a claims adjuster. It is vital to understand this person's role. The adjuster is not your friend. They are not your advocate. They may be friendly, they may be empathetic, but their primary job is to protect their company's financial interests. That means their goal is to close your claim for the least amount of money legally possible. Remember that in every single interaction, one of the first things they'll ask for is a recorded statement. This is a minefield. Insurance companies use recorded statements to lock you into a story and find inconsistencies they can use to deny or reduce your claim. If the accident was minor and fault is crystal clear, for example, you were rear-ended at a red light, a recorded statement is probably fine. But if there is any complexity, any question of fault, or any injuries involved, you have the right to decline or to say you want to speak with an attorney first. At the very least, before giving a statement, write down a timeline of the events so your story is consistent and based on the facts you documented at the scene. Next comes the vehicle inspection. The insurance company will send an appraiser or ask you to take your car to one of their preferred body shops. Be aware of a practice called steering. This is when an insurer pressures you to use their shop, which often has an agreement with the insurer to use cheaper, aftermarket parts instead of original equipment manufacturer, or OEM parts. You have the legal right in most states to have your car repaired at any shop of your choosing. Get your own estimate from a high-quality, independent shop you trust. Compare it to the insurer's estimate. If there's a discrepancy, your shop can submit what's called a supplement to the insurance company to cover the difference. Don't let the insurer bully you into a cut-rate repair job. If you were injured, the process gets more complicated. This is where your own policy's personal injury protection or medical payments coverage comes into play. This is no-fault coverage designed to pay your initial medical bills immediately, regardless of who caused the accident. Use it. It's what you pay for. Keep meticulous records of every doctor's visit, every prescription, every physical therapy session. Create a file. Keep every receipt. This documentation is your ammunition when it comes time to settle the bodily injury portion of your claim. Finally, you'll receive a settlement offer. For your vehicle, the offer will be for the cost of repairs, or if it's a total loss, for the actual cash value, what your car was worth the second before the crash. Don't just accept the first number they throw at you, especially for a total loss. Do your own research on Kelley Blue Book, Edmunds, and local listings for comparable vehicles. If their offer is low, send them evidence of why it's low and make a counteroffer. For minor injuries, the settlement will cover your medical bills and potentially an amount for pain and suffering. Again, if the offer feels insultingly low, you can negotiate. Be polite, be persistent, and base your arguments on the facts and the documentation you've so carefully collected. This entire process from the crash to the check is a marathon, not a sprint. By following this playbook, you're not just a victim of circumstance. You're an active participant, in control of the process, ensuring you get the fair outcome you deserve. But what happens when the damage is so bad that they declare your car a total loss? That's a completely different battle with its own set of rules and traps. The term total loss feels like a death sentence for your car. But what does it actually mean? It doesn't just mean the car is a crumpled wreck. It's a cold, hard calculation. An insurance company declares a car a total loss when the cost to repair it, plus its potential scrap value, is more than the car's actual cash value, or ACV. That's the key phrase right there. Actual cash value. It's what your car was worth the instant before the crash. Not what you paid for it. Not what a new one would cost. And most importantly, not what the insurance company first tells you it's worth. This is the start of the most common and frustrating fight you can have with an insurer. The adjuster calls you. They're very sympathetic. They say something like, "Unfortunately, the repair costs exceed the vehicle's value, so we're deeming it a total loss. But the good news is, we've calculated the actual cash value at $7,500. We can get that check out to you right away." Your heart sinks. $7,500? You know your car was worth at least 10, maybe 11,000. It was in great shape, you just put new tires on it, and you've seen similar models listed online for way more. But the adjuster sounds so confident, so final. They have a system. They use a third-party vendor. It all sounds official and non-negotiable. This is a carefully designed trap. They are counting on you to be emotionally exhausted from the accident, intimidated by the process and desperate for the money, so you can buy another car. They are counting on you to say, okay. Do not say okay. The first offer is almost never the best offer. It is a starting point for a negotiation you probably didn't even know you were supposed to have. Your first move is to politely say, "Thank you for the information. Can you please email me a copy of the complete vehicle valuation report you used to arrive at that number? This report is your battlefield map. It's usually generated by a company like CCC1 or Mitchell. When you get it, don't just glance at the final number. Print it out, grab a red pen and go through it line by line like a forensic accountant. First, check the basics. Did they get the year, make, and model right? You'd be surprised. Did they list the correct trim level? A Honda Accord EXL is worth significantly more than a base model LX. Did they get the mileage right? Is every single option and feature on your car listed? Power sunroof, leather seats, premium sound system, navigation, alloy wheels. Every single thing adds value. Omissions are incredibly common and can cost you hundreds, even thousands of dollars. Next, and this is the most critical part, look at the comparable vehicles or comps they used. The report will list several cars recently sold or listed for sale in your area that they claim are similar to yours. This is where the real manipulation happens. You'll often find the comps they've chosen are not truly comparable. They might be base models when yours was fully loaded. They might have significantly higher mileage. They might be located 200 miles away in a completely different, cheaper market. They will also apply mysterious adjustments to these comps. For example, they might find a comparable car listed for $11,000, but then apply a negative condition adjustment of $1,500 because of a vague note on a dealer's website, bringing the value down. They are actively searching for the lowest possible data points to justify their lowball offer. Now it's your turn to fight back with your own data. You are going to build a counter-report. Go to websites like AutoTrader, Cars.com, and even Craigslist or Facebook Marketplace. Search for your exact year, make, model, and trim level for sale within a reasonable radius, say 50 to 100 miles. Find at least 3 to 5 examples that are as close to your car's condition and mileage as possible. Save screenshots of these listings, including the vehicle's VIN, options, mileage, and the dealer's asking price. Don't look at the cheapest ones. Look for the average and higher-end listings that genuinely reflect the market. Dealers almost always list cars for more than they sell them for, but this is your ammunition. While you're at it, gather every single receipt for major work you've done on the car in the last year or two. Did you just install a new set of Michelin tires for $800? That's not just maintenance. That adds direct value. Did you replace the transmission for $3,000 6 months ago? That absolutely must be factored in. Your car was in better condition than the average vehicle on the road because of these investments, and you need to prove it. Once you have all your evidence, the marked-up valuation report, your own comparable vehicle listings, and your receipts, you draft an email to the adjuster. Be professional, be firm, and be organized. Start by saying, "Thank you for the valuation report. After a thorough review, I've found several discrepancies and believe the proposed actual cash value is not an accurate reflection of my vehicle's worth." Then lay out your case. Point out every error in their report, the wrong trim, the missing options. Then present your own comparable vehicles, explaining why they are a more accurate representation of the market price. Attach the screenshots. Finally, list the recent major repairs and maintenance, attaching the receipts, and argue for an upward adjustment in value. You're not just complaining. You are presenting a logical, evidence-based argument for a higher number. This usually gets their attention. The adjuster might come back with a slightly higher offer. The negotiation has begun. You can go back and forth a few times. But what if they refuse to budge? What if they stick to their initial ridiculously low offer and say, "This is what the system says. Our hands are tied." This is when you deploy your secret weapon, the appraisal clause. Buried deep in your auto policy is a clause that gives you the right to challenge the insurance company's valuation through an independent process. It's a form of binding arbitration. You invoke this clause in writing. Here's how it works. You hire your own licensed, independent appraiser to determine the car's value. The insurance company hires their own appraiser. The two appraisers then try to agree on a price. If they can't agree, they jointly select a third impartial appraiser, called an umpire, to make the final decision. The decision reached by any two of these three people is binding on both you and the insurance company. Invoking the appraisal clause is a power move. It shows the insurer you are serious and you know your rights. It takes the decision out of the hands of the company-friendly adjuster and puts it into the hands of outside experts. Often, the mere threat of invoking this clause is enough to make the adjuster suddenly find some flexibility in their offer, because they know it's going to cost them time and money to go through the appraisal process, and they might lose. And we're not done yet. Once you finally agree on a fair actual cash value for the car itself, there are other things you're owed. The settlement must make you whole, meaning it should put you back in the position you were in before the loss. That includes sales tax. If your car was worth $10,000 and the sales tax in your state is 7%, you are owed an additional $700 to cover the tax on your replacement vehicle. You are also owed the cost of title and registration fees. Don't let them leave this money on the table. It's rightfully yours. Dealing with the total loss is a high-stakes negotiation disguised as a simple transaction. They want to close the file as quickly and cheaply as possible. Your job is to slow the process down, scrutinize everything, and build an undeniable case for your car's true worth. It takes work, but it can easily mean the difference between getting a check for $7,000 and one for $11,000. By taking control, you transform from a victim of circumstance into a formidable negotiator. You've navigated the claims process, you've battled for a fair repair, and you've even mastered the art of the total loss settlement. But winning the battle of the claim is only half the war. Now comes the consequence: your insurance premium. How does a claim, even one that wasn't your fault, affect your rates for years to come? And what can you do to prevent your insurance costs from spiraling out of control after you've been through the ringer? That's the final crucial piece of the puzzle. And the answer is a hard and often expensive yes. A claim, even one where you were 100% the innocent party, can absolutely send your rates climbing. It feels fundamentally unfair, like being punished for someone else's mistake. And in a way you are. But to understand why this happens, you have to stop thinking like a driver and start thinking like an actuary at a massive insurance company. To them, you are not a person. You are a data point. And the moment a claim is associated with your policy, a new piece of data is added to your file. That data says you were in a specific place at a specific time that resulted in an accident. From a purely statistical standpoint, this makes you more likely to be in another accident in the future, regardless of fault. You might live in a high-traffic area, commute during dangerous hours, or park on a street with a lot of sideswipes. The fault doesn't matter as much as the simple, cold fact that an incident occurred. You've just proven that you exist in a riskier environment than someone who hasn't had a claim in 10 years. So your risk profile goes up and your premium follows. This information is tracked in a little-known database that is essentially the insurance industry's version of a credit report. It's called the CLUE report, which stands for Comprehensive Loss Underwriting Exchange. Nearly every insurer in the country reports to it and uses its data to price your policy. Every claim you make, home or auto, goes on this report. It details the date of the loss, the type of loss, and how much the insurance company paid out. And it stays there, shadowing you for up to 7 years. When you apply for new insurance, the first thing that company does is pull your CLUE report. It's their crystal ball into your past, and they use it to predict your future costs to them. Here's the truly insidious part. Sometimes, even just calling your insurance company to ask a hypothetical question about a potential claim can trigger an inquiry that gets logged. You might decide not to file the claim, but the record of your call, a documented instance of potential risk, can still be noted and used against you at renewal. It's a system that can feel stacked against you. So, how long does this financial penalty last? Generally, you can expect a claim to impact your rates for 3 to 5 years. The first renewal after the claim will almost always show the steepest increase. The second year might be slightly less, and by the 4th or 5th year, its influence will have faded significantly, assuming you've remained claim-free. But for those first few years, you're in the penalty box. This brings us to the most important question. How do you fight back? How do you manage this and prevent a single incident from derailing your budget for half a decade? You have 4 powerful strategies. First is the proactive defense, accident forgiveness. This is a feature that some but not all insurance companies offer. It's exactly what it sounds like. the company agrees to forgive your first at-fault accident, meaning they won't raise your rates because of it. Usually, you have to earn this perk by staying with the company for a certain number of years without any claims, or you can purchase it as an add-on to your policy called a rider. If it's available and the cost is reasonable, it can be an absolute financial lifesaver. It's a get-out-of-jail-free card for your insurance record. Ask your current or potential insurer if they offer it and what the qualifications are. Your second strategy is knowing when to even use your insurance. This is the critical threshold decision. Insurance should be for catastrophic events, not for minor inconveniences. Before you ever pick up the phone to report a small fender bender, you need to do some quick, unemotional math. Let's say you have a $500 deductible. You back into a poll and the repair estimate is $850. If you file a claim, you'll pay your $500 deductible, and the insurance will cover the remaining $350. That seems like a win, right? You save $350. But hold on. Let's say that claim causes your premium to increase by $40 a month. That's an extra $480 a year. And since that increase will likely stick around for at least 3 years, you're looking at a total premium increase of over $1,400. You made a claim to save $350, but it will end up costing you more than 4 times that amount in the long run. In that scenario, the smart financial move is to pay the $850 out of pocket and never tell your insurance company it happened. It stings in the short term, but it protects you from the long-term financial bleeding. Always weigh the cost of the repair against your deductible and the potential multi-year premium increase. The third and perhaps most powerful strategy is to re-embrace the number one rule we've discussed throughout this entire guide. You must shop around. This is never more true than after a claim. Your current insurer, the one who just jacked up your rates, has categorized you as a higher risk, but their competitors haven't. Different insurance companies have different algorithms and different appetites for risk. A 5-year-old speeding ticket or a minor at-fault accident might be a huge red flag for Company A, causing them to quote you a sky-high price. But Company B's algorithm might weigh that factor less heavily and see you as a much better bet, offering you a rate that's significantly lower, maybe even close to what you were paying before the incident. Loyalty after a claim is financial suicide. Your insurer has already shown you how they reevaluate you after an incident. You owe it to yourself to see how others will. Get at least 5 quotes after your rates go up. You will almost certainly find a better deal elsewhere, because you're no longer looking for the best rate for a perfect driver. You're looking for the company that is the most forgiving of your specific blemish. Finally, your fourth strategy is to be the auditor of your own record. Just like your credit report, you have the right to see your CLUE report. Under federal law, you can request a free copy of your report once every 12 months from LexisNexis, the consumer reporting agency that generates it. You should absolutely do this. Check it for accuracy. Is the date of the claim correct? Is the payout amount right? Most importantly, are there claims on there that aren't even yours? Mistakes happen, and a clerical error could be costing you hundreds or thousands of dollars a year by incorrectly labeling you as a high-risk driver. If you find an error, dispute it immediately. Cleaning up your CLUE report is like cleaning up your credit report. It's a simple act of financial hygiene that can have a massive payoff. And with that, we've closed the loop. We've covered everything from the building blocks of a policy to the hidden discounts, from the secrets of credit scores to the strategies for surviving the aftermath of a claim. The world of auto insurance is designed to be confusing. It's an industry that profits from complexity and from consumers who are too busy or too intimidated to look behind the curtain. But now you've seen behind it. You know that the price you're quoted is not a fixed, unchangeable law of the universe. It is a starting point. It is an offer. Your premium is a reflection of dozens of variables. The car you drive, where you live, your driving history, your credit, the discounts you ask for, and the company you choose. And on every single one of those variables, you now have the knowledge to exert control. Finding the best cheap auto insurance isn't a matter of luck. It is a skill. It's the skill of being a relentlessly informed consumer, of refusing to accept the first offer, and of understanding that the power in this transaction lies with the person who is willing to do the work. You now have the complete playbook. You have the tools not just to save a few dollars, but to potentially save thousands over your lifetime as a driver. The single biggest mistake you can make now is to do nothing. To let your policy auto-renew without a second thought. To accept a rate increase without a fight. Don't let that be you. Take 30 minutes. Pull out your policy. Use the knowledge you've gained. Make the calls. Fill out the online forms. The best deal you'll ever get is the one you fight for. The power is and always has been in your hands. Now go use it.